In just a few years, exchange-traded funds have ballooned as traders and retail investors embrace them as a quick, efficient, tax-efficient, and cheaper way to invest. Not so fast, according to CNBC's Herb Greenberg. He joins us now with more on our special man versus machine coverage.
Thank you, Maria. There is growing concern about the end-of-the-day rebalancing effect of some ETFs and the role they play in the wild swings happening during the final hour of trading. And since the May 6 flash crash, some critics are warning ETFs may be a monster in the making. Exchange-traded funds, lower fees and more tax efficiency compared to mutual funds, sector exposure without stock-specific risk, and the ability to trade in and out on the same day. That's why State Street created Spider. ETF volume has surged, now accounting for 30% of all NYSE daily trading. So, why are they being fingered for almost 70% of the bad trades during the May 6 flash crash? Was it simply growing pains in an otherwise healthy and promising asset class? Or something more perverse?
They all tie back to the same individual securities listed on the primary exchanges.
Harold Bradley, Chief Investment Officer of the Kauffman Foundation's $1.8 billion portfolio, worries the tail may be wagging the dog. In just the last 4 years, the number of ETFs has more than doubled to nearly 1,100.
We have leveraged ETFs. We've got options on ETFs. We have futures on ETFs.
While the number of underlying securities remains virtually unchanged.
This isn't magic. You can't take illiquid small cap securities and make them liquid just by creating an ETF. That's an illusion.
What's not an illusion, according to Cleve Rickard of Barini Associates, a doubling of market correlation in the past 2 years.
The average S&P 500 stock does the exact same thing as the market about 81% of the time.
What you're really saying is the market is like a herd right now.
Exactly.
Noel Archard runs BlackRock's iShares, the biggest U.S. ETF operator. He calls critics trying to pin the May 6th market mayhem on ETFs misguided.
It wasn't an issue with the exchange-traded funds. It was an issue with market structure. As the securities dropped so quickly, ETFs reflect the price of all those underlying securities that are in that portfolio. So as they dropped so quickly, it became very difficult to get price measures on the exchange-traded funds.
While Bradley acknowledges structural weakness, he insists ETFs are the real villains.
There's no question people are making lots of money, which is why every week we see another 10 ETFs, and may be exaggerating a little bit, but not much, but we're just slicing and reslicing and repackaging.
Oh my, Kelly Lynn, the producer with Steve Lewis, that was, they did a great job putting that together. Bob, to Bob Pisani here, you know, we've talked a lot about this. What I find fascinating in doing this whole thing was we'd go out and I'd be talking to people about high-frequency trading. I'd say, that's the villain here, and they'd turn around and say, no, you got it wrong. It's ETFs. And when you talk to Harold Bradley, and he would specifically get concerned about the way so many and the growing number of funds are feeding from the same ETFs, are feeding from that same trough of limited number of stocks. That's a big concern for him.
I agree with some of your points. I'm not sure I agree with all of them. I do think stocks have become more correlated. I've seen that's for sure. And I think part of the problem is because of ETFs, and that's the relationship. Great job, Herben.
Thank you.
Great job, Kelly Lynn, our producer for this series. Are ETFs really to blame for all the volatility, or are they be given a bad rap? Let's take a deeper look at what happened with ETFs back on May 6th and what regulators are doing now to help prevent another such crash. Joining me to discuss, Matt Hogan, president of ETF Analytics at IndexUniverse.com. By the way, a member of our model ETF Portfolio Committee. Hey, thanks very much for joining us, Matt. Let me ask you, and sort of get right to the point here, why were ETFs hit so hard by the flash crash? What happened there?
Well, I think it's pretty simple. ETFs are derivatively priced. That is to say that the price of an ETF at any time is determined by all of its underlying holdings. So if you get a bad print in, say, Procter & Gamble, that's going to filter out and hit a lot of ETFs. It's not just going to hit one stock. It's going to hit all 100 or 200
right.
ETFs that hold Procter & Gamble. So you had a ripple effect where it went through the market. I don't think ETFs caused the flash crash, but they certainly were hit at a higher level than individual securities.
Now, the SEC knows this. They've been trying to address this. They brought in circuit breakers, not just for stocks. They're bringing in circuit breakers for exchange-traded funds and notes as well. They've expanded that this week. Is that going to go a long way to address some of these issues?
Absolutely. Absolutely. If circuit breakers had been in place on ETFs on May 6th, you wouldn't have seen these issues, right? They would have cut off trading across all major market centers. Things would have settled down. The liquidity providers would have returned to the market, and we would have gotten rational pricing. They've done a great job. It does kick the can down the road, right? What happens when SPY closes and all that volume goes onto the futures exchange? That remains an issue, and we'll see how that works out.
One of the things that really bugged me that happened here, and I think it's woken up people to the dangers of market orders or to having limit orders in at certain situations, including exchange-traded funds. Talk to me about that, and how can people protect themselves a little bit more here?
Absolutely. The beauty of the flash crash, if there is a beauty, is that it's easy for you as an individual investor to avoid it. All you have to do is not put in sleeping stop orders. Don't put an order in on any security, ETF or stock, that says sell when it hits 30 with no cap on the bottom, because you never know when this could happen again, and your order to sell at 30 could get executed down 25, 20. You don't really control that. That simple rule would have protected you from the flash crash.
Now, one thing, and Herb and I were just talking about this, is the observation that stocks indeed have become more correlated, and this is a big problem that hedge fund traders have, who make a living out of going long one stock and short another, or one sector versus another. Why is there a higher correlation with stocks, and is ETF a factor in this correlation we're seeing?
Right. Well, first of all, I'm not going to cry for a bunch of hedge fund traders just because they can't find long short positions. But I do think ETFs and in general indexed investments have played a role. We've seen a transition in how people think about the market, from thinking about individual stocks, Henry Blodgett calling out $400 Amazon, to people really thinking about sectors and segments. It's actually a more efficient way for people to invest, but the net result is tighter correlations. I think that's probably okay to a point. Again, those hedge fund traders may be having a hard time, but they can find another way to make obscene amounts of money.
Yeah. Let me just ask you about it. Thanks for the plug for the hedge fund traders. Leveraged exchange-traded funds, 2 times, 3 times inverse correlated. Are these a special problem for the market? Do we need to look more carefully at them? What should, if anything, should be done?
That's a fair point. So there's debates on both sides of this equation. What Herb said was that ETFs, and I think he meant these leverage ETFs, are causing increased volatility at the end of the day. I'm going to qualify that. What happens in those funds is at the end of the day, the underlying banks have to put on more positions to true up their exposure to the market. It shouldn't actually cause the markets to be more volatile at the end of the day. You should see ramps either up or down at the end of the day. I think you're seeing that a little bit. That's probably true, but it's not a huge deal.
I got to let you go. Just 10 seconds. This rebalancing at the end of the day that everyone has and sees, is there a special problem around exchange-traded funds at the end of the day?
Only that ETFs are the most common leveraged instruments. It really focuses on leveraged and inverse leveraged exposure. ETFs just happen to be the only way you and I can access that.
Matt, thanks very much. Always nice to hear your thoughts on this.